afternoon. Welcome to Indianomics. I'm Lata Venkatesh. Equity markets around the world have found a spring in their step after the June CPI numbers from the United States came in at 3%. That's lower than the market consensus expectation of 3.1%. Core CPI, more important, fell from 5.3% in May to 4.8% in June. This has led to the CME Fed Watch tool predicting only one more rate hike from the Fed, if that. Elsewhere in China, in the last 24 hours, the June trade numbers are showing a massive 12.4% fall in exports and a 6.8% fall in imports in dollar terms, implying a slowing global and Chinese economy. With the two largest economies showing signs of slowing at various degrees and for various reasons, will the world manage a recession-less slowdown or at least a soft recession? What does this mean for EMs like India? For these and other questions, I'm joined by an elite panel of economists, Jahangir Aziz, Global Head of Emerging Markets Economies at JPMorgan, Robert Sockin, Global Economist at Citi with the US, and Aditya Bhave, Senior US Economist at Bank of America Securities. Gentlemen, thank you very much for waking up early for us and for joining this discussion. Well, first up, Robert, let me start with you. This inflation number, does it definitely give a feeling that the Fed is one and done?
Hello, and thanks so much for having me. It's a great question. I think going back to the numbers you were highlighting, it really was a very encouraging inflation print. If you look at inflation by sort of the key components, you're seeing continued disinflation in the goods sectors. You're seeing rent inflation finally starting to decelerate, and more of that is likely to play through. And probably most importantly, you saw much softer non-rent services inflation than was expected. And that's been sort of the key metric that the Fed's been hanging on to. I think at this stage, and you've heard this from Fed communication, they're still very likely to go in July. That is probably mostly still baked into the Fed's thinking. But now we're in a place where maybe we are starting to get a larger disinflation process than expected, particularly if this trend does continue and you get much softer services ex rent inflation, which tends to be very tied to a strong labor market. Then I think it gives a lot of reason for the Fed to pause after the July meeting. Now, there's a lot of data between now and the end of the year and after July, and it's just 1 month of data, and we still have a very tight, very strong labor market and very high wage growth. So there is, of course, the possibility that those pressures accelerate as you go later into the year. But right now, it looks like July is a certainty, but after that, it becomes much more meeting by meeting data dependent, and there's a lot more uncertainty on what the Fed does next.
Fair point. But Citi at the moment is going with one or one more?
No, we still have two. So we have the Fed going in. We still have July, and then we have them going in September. We think that the inflation pressures and the labor market pressures are still going to be strong enough that they do one more. Okay. There's a higher risk in our view that rate hike gets pushed out from September until later in the year. But we still think the base case is that they do two more hikes. But the risks have certainly risen that they do just one more.
Okay. Well, I want to get you, of course, to tell us about growth as a result of two hikes. But first, let's get everyone's views on rates. Aditya, yours. Would you go with one or two at this point in time?
We still have two more hikes. Similarly, we have them in July and September. July appears to be almost a done deal at this point, and agreed that September will be very data dependent. So going forward after July, the Fed is going to be much more data dependent. It's going to be a close call. Obviously, yesterday's CPI print reduces the risk of additional hikes, but I don't think it yet takes them off the table. Let's not forget the Fed has been head faked before. They were head faked last July They were also head faked in the fourth quarter of last year. Both times they thought that that was the start of a disinflationary trend, and then things turned around again. So they're not going to put too much weight on 1 month's worth of data. If we get a few more months of core goods disinflation or deflation, along with core services X of housing also looking much softer, then of course the Fed will be much more encouraged. And if you have that hand in hand with the ongoing slowdown in job growth that we've seen, then I think there's a much stronger case for the Fed to pause.
Okay. Well, already you, both of you are throwing some cold water on my and the market's enthusiasm, but that's the job of economists. Jahangir, I'll go a step ahead. While you can tell me what JPM's view on rate hikes is, also tell us if you think that even with 1 or 2 hikes, the growth is so good, so strong, that we probably will escape without too much of a recession.
We've been grappling with these two separate scenarios for a long time. So one scenario is what we broadly call the slip sliding scenario, in which, whether we get a modest, recession sometime in the fourth quarter and then get into the first quarter, or we manage to pass it without getting a recession, but just a slowdown, which is sort of the Goldilocks scenario. And then there's the other scenario, which is the, boil the frog scenario, that we're getting completely inured by these rate hikes, and that the rate hikes aren't having as much of an impact on both cooling down inflation or the labor market, and that the Fed, along with the other G3 central banks, will have to go a bit more. Now, a bit more is, questionable where the terminal rates are, what the timing is. And for the longest period of time, and even now, we sort of, not really exactly sure what the timing is. We can't be sure even what the terminal rates are. Now, obviously, the June print, which was a broad-based easing in core inflation in the US, just made the probability of that slip sliding / Goldilocks scenario a little higher, as opposed to the one where the Fed has to go much more. But I would say it's just a marginal move that has taken place. We still think that those two things are probably almost have the same probability, maybe a little bit more on the slip sliding scenario than on the boil the frog scenario. But as others have pointed out, 1 month of data does not change things. We need a trend to be set before we can make the call on that. As far as the rates are concerned, we actually have only one rate hike, which is the July, and like everybody else, the ones after that is going to be very, very data dependent.
Jahangir, I read that Boil the Frog report, and I have tried to summarize some of it. Those pointers are running as you speak. Which way would you lean now? I know Bruce Kasman is not leaning in either way. He says both these scenarios are possible. But what's your assessment at this point in time? Is there a late recession in 2024, for instance?
Right. So I think that what we have been underestimating for a long period of time is the fact that the decline in, or the slowdown in global demand, whether you look at the US or you're looking at emerging market or you're looking at Europe, coming out of the rate hikes would actually deliver the kind of declines in growth and labor market that would get us to this core inflation. The reason why we have been underestimating that is because, unlike any other cycle, in this cycle, there wasn't this massive increase in leverage on the private sector's balance sheet prior to the cycle, or prior to the peak of the cycle, or prior to when the central banks started to hike rates. And that is true for the US, it's true for Europe, and it is definitely true for emerging markets. So given the fact that we don't have that kind of leverage, the kind of impact you would get, let's say, from a 500 basis points of Fed rate hike, or almost a 500 basis points of emerging market rate hikes, taking the average on demand, has been much less. So I think that as long as these sort of buffers remain, which is the excess savings in developed markets, which is also the same phenomenon in emerging markets, I think we will get this resilience from growth. And therefore, if you ask me to make a call, I would say that the likelihood of a US-led or a global recession taking us. It's probably been pushed back somewhere in 2024 or, maybe the second half of 2024.
Okay, that's too early for equity markets to discount them. So they can make merry at least until then. Aditya, let me get to a few brass tacks before I come to more, involved questions. Do you think that the 10-year bond yield itself finds a ceiling at 4? Of course, it went above 4 briefly for a couple of days by a couple of basis points. But is that the ceiling, and what would be the range be now?
Right. So our rate strategists are still bullish on duration. I think that call basically makes sense. We're much closer, of course, to the terminal rate than to the start of the hiking cycle. And once you get to the terminal rate, markets are going to start thinking about rate cuts. We don't actually have the Fed cutting rates until May of 2024. But even if that's the case, I think what you're pricing in terms of the forward rate over the next several years is much lower. So that is helpful in keeping the 10-year rate lower. And then, of course, inflation expectations have remained fairly benign. I think this latest print of inflation also suggests that expectations don't really need to increase that much. So when you're thinking about a risk premium, especially related to inflation, that should be relatively moderate as well. So for all of those reasons, probably the 10-year rate has more room to fall than rise going forward.
Okay, that's music. After all, it is the cost of capital for the world in a way, the US 10-year rate. Robert, what about the dollar itself? The index gave us a pleasant dip. I mean, I say pleasant because I'm talking from an emerging market standpoint. But that dip, you think the dollar index, the DXY, really doesn't go above 103, 104 at least, the way things are?
It's a great question, and one that's changed a lot, honestly, over the last several months. We still have the dollar on balance weakening further from here, but the story has changed a lot. As I said, if you go back, or at least the risks around that story, if you go back a few months ago, we were expecting a big acceleration in the euro area and a big slowdown in U.S. growth, kind of happening around this time as you're moving into the second half of the year. That's been kind of playing out in the opposite way. Europe data have been much weaker than we expected, and U.S. data have been much stronger than we expected. So I think there is sort of shifting narratives within the dollar discussion about where, which pairs might be strengthening or weakening over time. So, that was one story that we have less conviction in than we did maybe a few months ago. We still, though, expect a stronger half for Europe in the second part of this year, and still expect the U.S. to eventually slow down. And as the U.S. eventually slows down and the Fed stops hiking and other parts of the world are accelerating, that should put downward pressure on the dollar. But I have to admit, as I said, we're seeing much more resilience in the U.S. and we're seeing the potential, at least the risk, that the Fed could even go higher from here, although that inflation print puts some more downside risk on that. But point being is it's a very fluid situation. On net, been surprised by U.S. resilience, and that has the potential to put more support on the dollar than we expect.
Okay. While preparing for this discussion, I did read economy reports from Bank of America, Citi, JPM, and even Morgan Stanley. And everyone's, recognizing the resilience of growth. On the other hand, Jahangir, there is likely to be a disinflationary impact from China?
Yes, so I think, that's been the big surprise. So we always, talked about at the beginning of the year, if you remember, when China reopened, we talked about the spillovers coming out from growth. Some of it did happen, but, it was a bit of a disappointment because China's growth momentum has gone down. But what I don't think that we had in mind was that this China reopening would have much bigger impact on the supply side. And that is what you're seeing across the board, at least on the goods side, that all of the supply side disruptions, et cetera, that we were worried about because of China's lockdowns, all of them have actually declined. In fact, most indicators would suggest that supply side disruptions or measures of supply side disruptions are probably the lowest we have seen in a very long period of time. And in addition to that, and I know that we keep worrying about, what happens to our bilateral exchange rates with the dollar, but we need to start, taking a, closer look at what's happening to our bilateral rates. And I'm talking about all emerging market bilateral rates with CNY. And by and large, you see almost like an 8-9% appreciation of bilateral EM exchange rates against CNY. If you add to that the fact that export prices from China, because of the disinflation that has happened in China, is now running at -7.
Yes.
If you add the two together, and if you believe that CNY depreciation has more to go because disinflation in China is only starting, and it's probably going to actually deepen, then I think that's the one bit that we did not even think about 3 months ago would have would occur. And I think that's the additional goods disinflation that is going to hit the world, both the US, DM, as well as emerging market ex-China.
Okay.
And I think as a result of that, core inflation, which has been very sticky, probably has a little bit of room to get relief.
Okay, well, the sum and substance of what you all are saying, and I think that's why even the Indian equity markets are reaching out to new highs with each passing day. The substance of what you all are saying is that there is resilient growth and a likely disinflation even in core. That's what Goldilocks is all about, isn't it? I'll ask you those questions after the break.